All right, what was the best stock-bond allocation ratio starting from the close of trading on Election Day on November 8th, 2016 until the day that stocks hit rock bottom on just this March 23rd of this year, 2020? And I picked the starting point as November 8th because, as you remember, stocks spiked upward after Trump won in 2016 because he's a businessman and he's regarded by people on Wall Street as someone who has a positive effect on the business climate and thus the stock market as well. Despite all the political hysteria from people like Hillary Clinton, I believe we will have global economic catastrophe if Trump is elected. Yeah, famous last words. So the stock market is a leading indicator. That's why I started with November 8th, 2016. And I did calendar rebalancing at the end of each year. Yeah, it would be better to do percentage rebalancing, but I don't have software to do that. And it would be just a pain in the ass to figure that out without software. So if you had a set it and forget it allocation ratio, such as if you own a combination of set it and forget it ETFs that automatically rebalance, or as I did, if you calendar rebalanced on your own at the end of each year, I'll bet that on March 23rd, when stocks bottomed out this year, if you had selected a low-risk allocation ratio like 28% stocks, 72% bonds, starting all the way back on the day before the election, I'll bet that you're thinking, I'm sitting pretty now, I made the right choice. Well, actually, even at this low point on March 23rd, the best allocation ratio was 90% stocks and 10% bonds. At this moment in time with a 90-10 portfolio, you did 2.8% better than with a 28-72 portfolio. And if we rewind back to February 19th when stocks hit their all-time high point, not surprisingly, you were doing 26.93% better than a low-risk 28-72 portfolio. Some other observations, unlike the dot-com crash of 2000, NASDAQ holding up very well in this correction. From peak to present, the NASDAQ has done about 10% better than the S&P. Also, consumer staples, as represented by the ETF XLP, only about 3% better than the NASDAQ. Also, defensive investors often turn to utility stocks. Look at how on March 23rd, the ETF IDU did worse than the S&P from peak to trough of this correction. So when people try to get cute by owning defensive stocks, are they really defensive? I say just own broad market ETFs. And when you own a sizable chunk of the NASDAQ, you're getting that tremendous upside during bull markets, and at least in this coronavirus correction, it has proven to be not as volatile as the S&P.